Okay, I would say we end with a banker, or not a real banker, because I'm working for an association. So I have experience from, from or with my colleagues from the banks in Luxembourg. I have to say, when I prepared this presentation, I asked myself several questions. And in fact, one of the things with long-term financing, for me, it's like fairy tales somehow. We would like to have a good ending, but it's just like when the princess is kissing the frog. You don't know if she will change into a frog, if the frog will change into a prince. What you expect is that they would have a good future together. And here, that's part of the problem in this long-term financing or long-term growth projects. You know that banks may be implied, but what would be their role? Would they act as agent, as lender, as a promoter themselves of long-term projects? Would they finance themselves, dams or whatever? Or would they help SMEs financing a long-term project, etc.? So for me, the real starter of this whole debate is you want a good outcome, but you don't know exactly what to expect. You don't know exactly who are the actors and what they can really do. Should they be banks? Should they be other alternatives? You mentioned, for example, crowdfunding. Should that come from retail initiatives, etc.? But what is for sure, on the other hand, is that everything is a balance. There is a need for every investor, because here we are talking about developing growth, etc. But if you want to develop growth, there should be an interest. There are risk and reward. And the big question for the moment is the reward for financing long-term projects large enough for the risk that I am taking compared to other short-term or shorter-term alternatives? I take a very simple example. As an investor, I can go on the stock market, have an extremely well-regulated environment, invest for 1 day, 2 days, 1 year. Everyone would call that short-term or long-term or whatever. Or I can invest my money into, let's say, a private equity fund for the next 10 or so years. What you expect in doing that, you expect additional incentives, or you expect additional returns. Those returns may be in different form. They can be, I could say, pure financial returns, but they can also be social returns. But in any case, there is a need to make a trade-off. If you want to do something short-term or long-term, if you want to go long-term, you need, let's say, some additional returns compared to, let's say, to short-term projects or short-term investment opportunities. Talking about the role of banks, I think, first of all, and we should not forget that banks are, I would say, qualified intermediaries between asset owner on the one hand and project developers, whatever their size, whoever they are. That can be SMEs, very small enterprises. That can be a person that wants to buy a house. That's also a long-term project. That can also be a long-term financing project, like building, like creating big buildings in Qatar or wherever, or all over the globe. So bankers are qualified intermediaries. They know their clients. They know their credits. They know the market. And a big strength of banks, I think, is that they are also able to follow the different projects. So they just not simply lend you some money and then you go with it. But usually there is a review of the financing of those projects over the years. So if you have financing for, let's say, a 10-year period, the bank will, on a at least yearly basis, review the conditions, if you are reimbursing, if things goes well, etc. But one important thing to bear in mind is that those banks are probably one of the unique actor in this type of field, notably because they also have a large and dense network. Across Europe, banks are present everywhere via branches, via subsidiaries, etc. They know extremely well both sides of the equation, both on the investing side and the availabilities of monies, etc., to be lent, and they know the different projects that they can lend to. In the case it's not enough, banks are also able to help mobilize institutional funding or access capital markets. And in that we are talking about the fact that SMEs may go for, let's say, a US-type approach where the financial markets are the only or the major source of financing. personally, I have my doubt that it's going to work. Why, again, taking this risk-reward equation? Why, again, as an investor, would I go to finance the bond from a credit from a small SME from a country that is not necessarily mine, compared to investing in a fund, for example, or investing in another financial product? We need to give those people some incentives. So I have my personal doubt on the fact that we can create a large SME market, or it depends on the definition of SMEs, perhaps, but accessing financial markets for all the entrepreneurs, I think it's an illusion, or at least not in the context that we know today. Another point that I want to make is that for banks, we mentioned regulation from various angles, mostly this morning from the prudential side, but there are also other aspects on the market side and on the other part of the balance sheet or for the other clients. And in fact, for banks, why do they do business in the end? Because that's where everything would end up. They want to satisfy their clients, and that's, I think, the priority. Be that from investing side or be that for lending. They want to do some business. They want, by that, to promote the economy, which would then develop their business further. And banks are part of that ecosystem, so they have a vested interest to develop the economy, develop big projects, develop long-term initiatives, etc. The problem is that with the crisis, that if I say it, I'm not sure that my boss would be very happy with me, but banks have created a crisis in the past. Let's put it this way. Now they are facing regulation, and in fact this regulation is extremely dense, but the problem is that by its density, I think that one of the major problems that banks have today is to understand all the implications of those different regulations, and above all the interactions. They have more or less no certainty about the future. They're confronted to many rules, sometimes converging, sometimes diverging. We know, for example, that in the next few weeks or perhaps months, if things goes bad, we would have a Liikanen report, just like the Volcker rule in the US, where banks would have to split commercial activities or retail activities from investment banking. Perhaps that's a good idea, but for banks, those are uncertainties. We have CRD that has increased dramatically the cost of capital. We have banking union now with EU supervision, same rules for everyone, everywhere. We talked about that. If you are a SIFI, which I see some large banks here, you are subject to additional constraint in terms of capital. Then you need to allocate your priorities. And if that's not enough, then would come in the next years the shadow banking regulation. So all the securitization and all the alternative financing would probably be subject at some stage to similar regulation to the banking regulation. So you have no alternatives in terms of opportunities to finance, in terms of instruments, and then you have the interaction with the other part of the balance sheet. It's the MiFID rule, for example. If you want your clients to invest, or if you want to promote initiatives let's say in the fund business, because I think that may be a good way. You are subject, if you advise those clients, you are subject to those rules, and you have to be prudent as well on that. You have also the interaction with EMIR regulation. You have to hedge your position if you want to take some credits. You may be willing to hedge them. And if you want to hedge them, you have to go to a clearinghouse where you have to put margins for collateral. So in the end, you have already by the regulation a lot of allocation of resources for your own capital. And I do agree with your point of view that SME were not the cause of the financial crisis. But one important thing is that we have to bear in mind that banks do not give money. They do not give money away. They lend money. And they lend money against the idea of making some profits, of course. They have to develop themselves. They are held by shareholders. But of course, also because of regulation. They have to comply to a certain amount of regulation, and they have to prioritize at a stage where they do not know exactly where to go and what will be the impact of the different regulations. They have to be prudent as well on their side.